SG FICCI, Shri Ruchin Goel from BCG, members of FICCI, IBA, distinguished guests, members of the media, ladies and gentlemen. I'm extremely delighted to be back at the FIBAC annual conference. This conference is special as it brings together industry players, financial sector players, regulators on a single platform to discuss vital issues of contemporary relevance. So if we are looking at the industry and business sector and the financial sector, including the regulators and other authorities, I think almost every segment is represented here through their representatives and through their leadership. I would like to congratulate the FICCI and the IBA for organizing this annual conference, which is unique in its own way. The Indian economy is now at a critical juncture. Massive changes are taking shape in various economic sectors and markets, and the country is geared for orbital shifts. Our nation's journey towards becoming an advanced economy is drawing strength from a unique blend of factors, and these factors would include a young and a dynamic population, a resilient and diverse economy, robust democracy, and a rich tradition of entrepreneurship and innovation. In this background, I have chosen to speak on the topic India at an inflection point, some thoughts. I have structured my talk under 4 major themes. First, I would like to speak on India's growth prospects and the approach we need to follow going forward. Second, I would like to dwell upon recent developments in inflation and monetary policy. Third, I propose to highlight certain issues relating to strengthening of our financial sector. And finally, I would spell out certain expectations from the financial sector. Let me first touch upon the growth prospects of India. Much has been talked about it, much has been discussed about it. Various authorities have been giving out various numbers. So it is necessary to cut out the noise and to sort of exactly analyze where India's growth story stands and what is the outlook forward. The Indian economy, as all of you would know, rebounded strongly from the COVID-19 induced contraction, growing at an impressive annual average of 8.3% in the last 3 years. For the current financial year, the Reserve Bank has projected a growth rate of 7.2%. The IMF has also projected India's growth prospect. They have in fact revised their growth projection for India upwards and have now placed it at 7%. And 2 days ago, the World Bank has also upgraded India's growth forecast to 7% for the financial year 24-25. So as you can see, I think the projections made by all the agencies, international agencies, as well as the Reserve Bank, I think our perceptions and projections are converging. The National Statistics Office, that is the NSO, has placed India's GDP growth at 6.7% in the first quarter of this year. Now, naturally, that has raised some discussion and about whether the 7.2% projected by the Reserve Bank would actually materialize or not. Now, let me clarify and let me explain this entire aspect in slightly, in some detail. Now, notwithstanding the moderation in growth from the previous quarter and being below our projection in Q1, the Reserve Bank had projected 7.1%. The actual growth number has come to 6.7%. Now, the data actually shows that the fundamental growth drivers of the Indian economy are actually gaining momentum. They're not slowing, they are gaining momentum. This gives us the confidence to say that Indian growth story remains intact. And I would like to emphasize this point. Private consumption, which is the mainstay of aggregate demand, with a share of around 56% of GDP. 56% of the GDP is attributed to or comes from private consumption. Now that has grown at a rate of, in fact, that has rebounded to 7.4% growth from a very feeble 4% growth in the second half of the previous year. That is 23-24. In the second half, private consumption grew by 4%. First quarter of this year, private consumption has grown by 7.4%. This reconfirms the revival of rural demand. FMCG players, FMCG companies, if you talk to them, I mean, the data which comes out shows that clearly the rural demand is picking up and has picked up. The other important driver of growth, now apart from consumption, which accounts for 56% of the GDP, the other important driver of growth is investment, which accounts for 35% of GDP. Now, investment has grown at 7.5%, keeping with the recent momentum. So more than 90% of the GDP, that is private consumption 56% and 35% coming from investment. You know, these are the drivers of the GDP calculation. Now more than 90% of the GDP expanded at a robust pace and materially above 7%. The headline number, however, came lower against the backdrop of muted government expenditure of both the center and the states, perhaps due to the elections. Excluding government consumption expenditure, GDP growth would have worked out or works out to 7.4%. Now, I don't want to get too much confined into these numbers, but I think it's when we talk that first quarter GDP has slowed down to 6.7%, we have to take note of that. We should not brush it aside. But at the same time, it is essential to analyze carefully actually from where where exactly the growth has slightly moderated, or which has actually, which has had a moderating influence on the growth, and to deal with that particular segment, while of course not losing focus of the other growth drivers. Now, these are from the demand side, investment and consumption. From the supply side, while agriculture grew modestly at 2% in the first quarter, it is likely to perform better in the remaining months of the current year on the back of good progress of monsoon, good sowing of kharif crops, and good moisture conditions for the next rabi crop. Industry and services, which are also important components of the supply side factors which impact our growth. Industry and services recorded a growth of 7.4% and 7.7% respectively. Industry grew at 7.4%, services grew at 7.7% in the first quarter. Now, they underscore the continued strength in economic activity. Construction activity, which is a very important segment of any growth assessment. Construction activity remained robust, growing at 10.5%. Now, according to the Reserve Bank's latest data, bank credit to agriculture and allied activities remained robust and increased by 18.1% year-on-year. Credit to industry increased by 10.2% year-on-year in July this year, as compared to 4.6% in July 2023. Within industry, credit to MSMEs, and as you know, MSMEs are an important component of our economy. Within industry, credit to MSMEs also grew at 14.4% year-on-year. Bank credit to industries such as chemicals, chemical products, food processing, petroleum, coal products, and nuclear fuels and infrastructure has been quite strong till July 24. The enhanced credit flow to industry, along with an all-time high capacity utilization in the manufacturing sector capacity utilization is at 76%, which we gave out this number in the last MPC statement. Now, the enhanced credit flow to industry, along with an all-time high capacity utilization, points to an upturn in investment cycle as reflected in the NSO data. It is evident that India is on a sustainable growth path. Consumption and investment demand, as I said, the two main drivers of growth are growing in tandem. Government expenditure of the center and the states is likely to pick up pace in line with the respective budget estimates in the remaining quarters of the current year. Strong balance sheets of banks and corporates have created congenial conditions for further support of capital expenditure. Corporate profits, net, that is net corporate profits, have grown by 14.2% in the first quarter of 24-25. This we have give out. In fact, this is based on Reserve Bank survey of 2,934 private non-financial corporates. Now, this data was released very recently by the Reserve Bank. It is there in our website. I have given a reference to this in the footnote of my address, and this particular address will be uploaded in the Reserve Bank website, so you can have a look at it. So therefore, Reserve Bank survey of 2,934 listed private non-financial corporates have shown that their net profit in the first quarter have grown by 14.2%. So considering all these factors and also the fact that the budget provision, the government capital expenditure provisions in the current budget, in the current year's budget are also robust, taking into account all these factors, overall, I would therefore like to say that the Reserve Bank's projection of GDP growth at 7.2% for the current financial year 24-25 does not appear out of place. As regards growth prospects in medium to long term, it is felt that Indian economy is on the cusp of transformational shifts. The fact that growth is on a rising trend, despite modest global growth and continuing global challenges, shows that structural drivers are playing a bigger role in India's macroeconomic outcomes. I would like to repeat, I would like to read this sentence again. All these things show that structural drivers are playing a bigger role in India's macroeconomic outcomes. These drivers would include policy push on creating robust physical infrastructure, our fast-growing digital public infrastructure, innovation and technological advancements across sectors, and critical reforms in key areas. To realize this aspiration of transitioning from an emerging to an advanced economy by 2047, the Indian economy would need a multi-pronged and multi-sectoral approach. Our focus should be on employing all engines of growth from both supply and demand sides. The supply side focus must encompass agriculture, industry, and services. We should be mindful of the fact that agriculture possesses huge potential in India, and agricultural activities in horticulture, edible oil, dairy, poultry, food processing, etc. could indeed be the focus areas. And these are areas which have the potential to create additional employment in large numbers. Our approach should be to enhance productivity as well as quality of our produce so that we gain a significant share in world exports while meeting our domestic requirements. The potential contribution of manufacturing will be pivotal to generate additional employment. Initiatives such as Make in India, Startup India, One District, One Product, and Production Linked Incentive, that is PLI scheme, among others, are helping the manufacturing sector gain competitiveness and grow faster. The MSME sector in particular holds a lot of promise to step up growth and employment opportunities. Overall, the manufacturing sector must take the lead in niche areas to compete globally. The services sector, which has remained the mainstay of growth over the last several decades, must explore new vistas of opportunities with focus on higher value-added services. In addition, requisite focus on research and development, that is R&D, is also vital for productivity and competitiveness. Together with government initiatives, including the announcement and the setting up of R&D fund, the private sector may also be an active partner in this field. As I stated earlier, key demand drivers like consumption and investment and exports of goods and services will have to move in tandem. Higher domestic consumption would help to insulate our economy from the vagaries of external uncertainties. Investment remains critical for sustainable growth of the economy, and given the current confluence of favorable factors, it is time for the private corporate sector to also come forward in a big way. There are signs of private sector investment happening in a number of sectors, as I listed out, but I think the scope can be more, and it is for the private sector players to really take their own call. I'm no one to give advice on this issue, but from a regulator's perspective and from the perspective of where our economy stands, from the perspective of the opportunities that lie ahead, from the perspective of the outlook that we have ahead of us, I think it is time also for the private sector to ponder, to consider, and step up their investment in their respective businesses. The potential of external demand can be utilized to our advantage by getting integrated into global supply chains. This is one issue which has been talked about quite a lot, but I think industry players together with financial sector players, we and the various authorities concerned, we all need to work together and strategize how to enable India to get into the global supply chains is with a much bigger share in the global supply chain, in the entire global supply chain universe. A holistic approach to nurture and accelerate broad-based growth of the economy would also necessitate preservation of the gains of past reforms and accelerating India's reform journey with more reforms. I repeat, a holistic approach to nurture and accelerate a broad-based growth of the economy would also necessitate preservation of gains of past reforms and accelerating India's reform journey with more reforms. From an economic perspective, reforms that have imparted paradigm shifts and buttressed our stability and growth story would include, and I have listed 6 of them, there are many more, but I have listed 6 major reforms which have indeed resulted in a paradigm shift and which have really sort of given the necessary push to strengthening our economy and to take it to the next level of development. And these 6 reforms, apart from others, of course, which I have listed, these 6 would include, number 1, shifting from administered exchange rate of the rupee to a market-determined regime. Number 2, stoppage of automatic monetization of budget deficit financing by the Reserve Bank. Number 3, enactment of the FRBM Act. Number 4, introduction of the flexible inflation targeting framework. Number 5, enactment of the Insolvency and Bankruptcy Code. And number 6, implementation of the Goods and Services Tax, that is GST. Each of these 6 reforms have yielded long-term positive outcomes. These reforms need to be augmented by reforms in land, labor, and agricultural markets. While we have made some progress in these areas, lot more needs to be done both at the national and subnational levels. Improvements in ease of doing business, especially at local levels, will go a long way in boosting our competitiveness. Now, after highlighting on these growth aspects and the growth story, the second area which I would like to highlight is on inflation and monetary policy. In early 2022, the flare-up in food, commodity, and energy prices following the outbreak of the war in Ukraine led to a sharp increase in inflation. This was further compounded by a series of adverse domestic shocks. The decisive steps taken by the Reserve Bank, together with the supply-side measures from the government, and the cooling of international commodity prices have led to a downward shift in inflation from early 23-24, that is from the early part of the financial year 23-24. Nevertheless, the pace of disinflation is frequently interrupted by volatile and elevated food inflation. It is the headline inflation that matters. It is the headline inflation, with food inflation having a weight of 46% in the headline inflation, which the people understand. With the monsoon progressing well and the healthy kharif sowing raising prospects of better harvest, there is greater optimism now that food inflation outlook could become more favorable during the course of the year. However, I must add and emphasize that we have to remain watchful of how the forces impacting inflation play out. The balance between inflation and growth is now well poised. The balance between inflation and growth is well poised. You know, our monetary policy, the legal framework which the enactment in the Reserve Bank of India Act has mandated the Reserve Bank to achieve is to maintain price stability, which is defined in terms of maintaining inflation at 4% with a tolerance band of 2% on either side. That is, it should remain between 2 to 6%, but the target is 4%. So the mandate given to the Reserve Bank under the Reserve Bank of India Act is to maintain price stability defined in terms of 4% target plus minus 2%, while keeping in mind the requirements of growth, while keeping in mind the objective of growth. So from that perspective, I would like to say that our analysis shows that at the current juncture, and also based on our outlook, the balance between inflation and growth is well poised. We must successfully navigate the last mile of disinflation and preserve the credibility of flexible inflation targeting framework, which is a major structural reform. The best contribution that monetary policy can make for sustainable growth is to maintain price stability. I would now like to turn to the third component of what I wanted to say, that relates to financial sector, strengthening the foundations for the future. India's financial sector has repeatedly demonstrated its ability to overcome challenges and crises. As a regulator, we have done our best during successive global shocks which the Indian economy faced, along with so many other countries. And I must mention here that it was ultimately the joint effort, it was ultimately the cooperation between the Reserve Bank as a regulator and the financial sector players like the banks, the NBFCs, and other financial sector players. It is this active cooperation and it is this open door communication between us during these periods of successive shocks which has enabled our country to be where it is today in terms of financial stability. So the financial sector has repeatedly demonstrated its ability to overcome the challenges and the successive shocks from various global factors. The financial sector showed remarkable resilience during the COVID and also in the aftermath of the COVID-19 pandemic. Today, all key indicators of the financial sector demonstrate robust health. This resilience, combined with other forces, can act as critical driving forces for India's future. In this milieu, financial sector needs to even further deepen financial inclusion, broaden access to credit and other financial products, and support overall inclusive growth. It also needs to drive innovation in digital banking, foster sustainable finance, and build robust financial ecosystem that can withstand emerging challenges and facilitate higher trajectory of growth. With the financial sector now in a strong position, it is our collective responsibility to safeguard this stability, especially in an environment of heightened global uncertainty. Financial institutions must continuously assess and refine their business models, recognize and deal with emerging risks, and remain focused on capitalizing on every new opportunity. This brings me to the important issue of inclusive growth. But before going into inclusive growth, I think it's a point which has already been touched upon by the previous speakers and by also the presentation that was made here. I think a key focus area, and I'm not saying anything new or which is not known, but I feel it is necessary to constantly, keep reminding ourselves that these should be our priority focus areas. I think we have to be also mindful of several non-financial risks. The financial sector, the financial parameters of the financial sector today are strong and robust, but we also should be mindful of the potential, the sources of what you call non-financial risks, which may affect the financial sector. And in this, I would like to include elements like cybersecurity, managing third-party risks, managing spillovers from a rapidly changing global environment, managing and adopting new technology into our operations, into our business practices, and several such initiatives. At the Reserve Bank of India, we have been embracing technology, and we are trying to keep up ourselves with regard to utilizing technology, with regard to utilizing AI in our internal operations, whether it is supervision or in other areas. UPI is a great example about which the whole country can be proud of. As you are aware, central bank digital currency, that is CBDC, e-rupee. We are one of the, we are among the very few countries which are running pilots. I would also like to mention, we have already announced in public domain that we are setting up a cloud facility for storage of financial sector data of all financial sector players. And this is something which will be of particular benefit to the smaller entities in the financial sector, whether they are small NBFCs or they are medium-sized NBFCs or small private banks, or for that matter, the urban cooperative banks. So we are working on the cloud facility. It is work in progress. We have announced, in the last week in a conference in Bangalore, I announced on behalf of the Reserve Bank of India the launching of the pilot for the Unified Lending Interface, ULI. And I had gone on to say that, as you know, JAM Trinity has been talked about a lot. But the new Trinity, which can really be a game changer for our progress in the years to come, will be the new Trinity of JAM, UPI, ULI. So, and as you may be aware, we have already given out an agenda for RBI at 100, where we want to see the Reserve Bank in its centenary year in 2035. So let me now turn to the issue of inclusive growth. While traditional metrics of economic growth like GDP and per capita GDP are important indicators of progress, they alone do not capture the full picture of what it means for a nation to be truly developed. India has made remarkable progress in extricating people out of poverty. A truly developed India must ensure that every citizen, regardless of their socioeconomic status, has access to financial services and has the required financial literacy. By expanding access to banking, credit, and insurance, and by harnessing the power of digital platforms, the financial sector can drive inclusive growth that extends to the most marginalized sections of our society. The priority sector lending, that is the PSL program, remains crucial in addressing credit gaps for underserved segments. Introduction of business correspondents, that is the BC model, has further enhanced financial outreach. The Financial Inclusion Index, introduced by the Reserve Bank of India, has improved from 53.9 in 2021 to 64.2, reflecting to 64.2 in 2024. That is the data we released on March this year, reflecting the strides made in providing access to financial services. Now, while we have provided access to financial services, there is still more to be done to improve the usage and quality of these services. Two more key drivers need to be prioritized. Enhancing financial literacy and leveraging technology. The Reserve Bank has engaged in both self-driven and collaborative approaches to promote financial literacy. We run multimedia public awareness campaigns, outreach programs, as well as targeted financial literacy awareness programs. The banks, on their part, are also operating similar awareness programs and financial inclusion, financial awareness outreach events. Now, collaborating with other financial sector regulators, the Reserve Bank has assisted in the establishment of the National Center for Financial Education, NCFE, to bolster financial literacy efforts. With support of banks and NGOs, 2,421 Centers for Financial Literacy, that is CFL, have also been set up, covering almost all blocks in the country. This is an important initiative which has been undertaken by the Reserve Bank, and 2,421 centers have been opened, covering almost each and every block of the country. On the technology front, the Reserve Bank, as I just mentioned, has taken number of initiatives to facilitate development of digital public infrastructure and innovation. The UPI has revolutionized the digital space, digital payment space. Other initiatives like Regulatory Sandbox and the Reserve Bank Innovation Hub at Bangalore have fostered a robust environment for enriching our fintech ecosystem. The commencement of the Reserve Bank's pilot project for frictionless credit, that is end-to-end digital platform of Unified Lending Interface, ULI, as I mentioned a little while ago, is expected to revolutionize access to credit, especially for farmers and MSMEs. Now, the final aspect I would like to touch upon is expectations from the financial sector. Having spoken about safeguarding financial stability and financial inclusion, I would now like to highlight some specific areas where I believe the financial sector can contribute to India's growth aspirations. Now, I have been in all my address talking about issues of risk management, compliance, assurance functions, and the like, internal audit. But today I thought, while those points are important, I do emphasize them, but I thought I will take out a little time to talk on some focus areas which is something which the financial sector consisting of banks and NBFCs need to focus on and these are the initiatives which can go a long way to contribute to India's growth aspirations. And in that, the first one I would like to highlight is improving female labor participation. India's female labor force participation remains lower than the global average. The gap underscores the urgent need for targeted initiatives such as improving girls' education, skill development, workplace safety, and addressing social barriers. This is for everyone who has a business. This is for policymakers, authorities, governments, as well as the major players in our business and industry and in our financial sectors. Having said that, I would like to say that entrepreneurship is a vital component of economic empowerment. Entrepreneurship is a vital component of economic empowerment. Yet in India, less than 1/5 of MSMEs are owned by women. Women entrepreneurs often face significant challenges, including limited access to capital, restrictive societal norms, and difficulties in accessing affordable finance. The financial sector has a crucial role to play in bridging this gender gap by implementing supportive policies, creating tailored financial products, and leveraging fintech innovations to offer better access to finance. This can be pursued on two fronts. One, by providing higher employment opportunities to women in financial institutions, and two, by supporting women entrepreneurs through government-sponsored schemes as well as banks' own schemes tailored to suit the businesses promoted by women. Banks could also actively explore onboarding larger number of women banking correspondents, that is BCs, and in some states they are known as bank sathis or sakhis, especially from among the SHG members. The next point, 2 points I have actually chosen to highlight are areas where the financial sector, particularly the banks and NBFCs, can contribute to our growth story. One, I said, improving female labor participation, including entrepreneurship, including encouragement and support to women entrepreneurs. I'm not saying that you do any I'm not asking that you dilute your lending standards, but within the lending standards, what I'm saying, the underwriting standards, don't dilute. I'm not asking for any dilution of underwriting standards. What I'm emphasizing is that within your parameters, within the underwriting standards the banks are expected and required to follow, there is considerable scope for tailoring products, for structuring loans and offering finance in a manner to support businesses promoted by women entrepreneurs, businesses, howsoever big or mid-sized or small. The second aspect I would like to highlight is supporting the MSMEs. With our large young population, we need to fully tap the potential of MSMEs to drive employment and economic development. Despite their importance, many MSMEs remain small-sized and unable to scale up effectively due to various challenges, with access to affordable finance being one of the barriers. The financial sector may play an active role in supporting MSMEs. Banks and financial institutions may develop tailored financial products and services that cater specifically to the needs of the MSMEs. These tailored products and services would include offering flexible credit options, improving access to working capital, and providing financial support that accommodates the unique cash flow cycles and growth stages of MSMEs. Now, this can propel the MSMEs to expand, enhance their productivity, and contribute more significantly to job creation. Let me now conclude. The Indian economy is forging ahead with macroeconomic and financial stability and a favorable growth inflation balance. The policy mix pursued in the recent years has strengthened the underlying fundamentals of the economy and augmented the buffers. Consumption, which has been our main driver of growth, has picked up pace with recovery in rural demand. Investors' confidence is at an all-time high. Banks and corporates demonstrate robust balance sheets, and structural reforms are playing a big role in pushing forward our growth frontiers. We are living in a dynamic and uncertain world, and we need to remain vigilant and continue to build strong buffers. New opportunities are knocking at our doors, and when I look at the entrepreneurial zeal and the talent of our younger population, it makes me more confident of India's long-term growth prospects. Thank you. Namaskar.